Today, we will talk about 7 important finance trends, 2023 to 2026. So before we get started, make sure to hit that like button, also subscribe to my channel. From crypto to DeFi, the world of finance is changing faster than ever. Many of these new trends come on the back of changing technology, while others are the result of a renewed focus on the customer. 1. The financial services industry embraces blockchain. For years, blockchain technology has been synonymous with cryptocurrency. However, experts believe that the technology will now become more integrated with existing financial systems. For example, using blockchain would allow banks to conduct cheaper, more efficient transactions while maintaining tight security. It can also be used to handle peer-to-peer lending, an industry that could see a growth of up to $150 billion by 2025. More banks are transitioning to cloud-based banking in 2023, and blockchain will no doubt play a role in this. AXA, the French multinational insurance company, uses blockchain technology when insuring clients against flight delays. 2. More people download personal finance apps. Finance apps like Mint, Prism, and EveryDollar provided exactly what people were looking for, and their popularity went through the roof. These apps not only help people manage their money, but they offer ways to invest in stocks and crypto. It's not just the ability to manage your money remotely that's attracting people either. People specifically like having the power to run their financial world, literally, in the palm of their hand. And as the US adopts open banking, which will make financial apps even safer, this number will likely increase. And skeptical users who harbored security concerns might be persuaded to take a second look. Square's Cash App remains the most popular personal finance app available, and among its list of benefits is a reward system, which ties into what we discussed above about customer loyalty programs. 3. More people get their money professionally managed. A new kind of wealth manager is quickly becoming the de facto money manager for many consumers, RIA. A registered investment advisor, RIA, is a firm that is regulated by the Securities and Exchange Commission and specializes in giving financial advice and managing investments. Compared to typical broker-dealers, RIAs have what is known as a fiduciary duty to their clients. This means that they are required to put their clients' interests before their own when making financial decisions. At the end of 2020, RIAs managed a collective $110 trillion supplied by over 60 million clients around the US. This is compared to roughly $20 trillion at the beginning of this century. 4. Loyalty programs drive repeat business. From half-full punch cards sitting in the back of your wallet to website-specific rewards programs, the idea of a loyalty program is nothing new. Loyalty programs have long been a popular way to keep customers coming back, but they're usually offered in retail and the food industry. Now, loyalty programs are practically mandatory, even in the financial services industry. Many believe that they're only going to get bigger, better, and more competitive. In August of 2021, an American banker Moneyville Agency's survey of banking customers found that regardless of financial institution or product, rewards and loyalty remain paramount to the customer experience. And more than 80% of millennials and almost 75% of baby boomers like to get rewards simply for engaging with their favorite brands, whether or not they make a purchase. A survey conducted by McKinsey & Company showed that consumers who belong to paid loyalty programs are 62% more likely to spend more money on that brand. 5. Banks further embrace the cloud. Banks were already gravitating towards the cloud pre-pandemic, but the pandemic really sped things up. As people grow warier of physical contact, the demand for digital services rises, so banks need a way to scale up quickly. Banks and credit unions will be a part of that, with heavy hitters like JPMorgan Chase and Arvest Bank already converting part of their core systems to a cloud-native platform. Jim Maris of the financial brand believes that cloud banking is the future, citing the fact that IBM has developed cloud solutions specifically for the financial industry. Another survey, this one conducted by Harris Poll and Google Cloud, showed that of the 1,300 financial services leaders polled, 83% of them were using the cloud as part of their primary infrastructure. Artificial intelligence plays a big role in the adoption of cloud services. Not only does AI provide chatbots, but it can also analyze transactions, monitor for suspicious activity, and perform other tasks just as well, if not better, than human counterparts. Investing in AI would generally cost more than banks would be willing to consider. But if AI was packaged with cloud services, that becomes a very appealing offer. 6. Banks move past overdraft fees. Overdraft fees have long been a thorn in the side of bank customers everywhere. They're known for not only being excessive, but also having a tendency to snowball and reach absurd amounts. Of course, that doesn't mean that banks will just up and get rid of them. Though Ally Financial did just that last year and Capital One followed suit in January. But multiple institutions are implementing new features designed to help customers avoid fees at all costs. Bank of America added a feature called Balance Connect, which allows users to automatically transfer money to and from accounts to prevent possible overdraft fees. 7. More non-tech people get into crypto. As of November of 2021, total cryptocurrency market capitalization had topped out at $2.79 trillion. Last year saw a lot of traditional investors taking an interest in crypto, with 7 out of 10 of them planning on taking the plunge in the future. They're not the only ones showing interest either. Venture capitalist firms purchased over $27 billion in crypto in 2021, almost 5 times more than they spent in 2020. In a move that should signify that crypto is, in fact, getting even bigger, U.S. President Joe Biden recently signed a bill that requires all crypto exchanges to be reported to the IRS. This sort of oversight wouldn't be necessary if cryptocurrencies weren't poised to become even more popular. The very first Bitcoin ETF, Exchange-Traded Fund, hit the New York Stock Exchange in October, allowing traders to invest in a more conventional way. Instead of buying crypto, they're instead able to invest in companies that have a financial stake in crypto. So they're still susceptible to its volatile nature. They're just inserting a middleman. As of September 2021, the El Salvador government now demands that all of its local merchants accept Bitcoin as legal tender. This prompted other Central American countries, like Honduras and Guatemala, to begin looking into central bank digital currencies. This also had an impact on the U.S., where 27% of Americans polled answered in favor of adopting Bitcoin, while some countries, namely China, are strongly opposed to cryptocurrency. The vast majority are considering how they can bring crypto into the fold. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.